Hello, it's Mr. G, your business teacher. In this series, we're covering everything you need to know about finance in a Gcse business. Today, we're starting with the finance function and its purpose in business. Understanding how finance works is essential because it affects decision-making, business growth, and financial stability. The finance function is responsible for managing money within a business. Every company needs money to operate, expand, and remain competitive. Finance is used to pay employees, purchase stock, invest in marketing, and fund business growth. Without proper financial management, businesses risk running out of cash and failing. Finance supports businesses in several ways. One key role is funding daily operations. Businesses need to cover rent, wages, and utility bills to keep running smoothly. For example, a small CAF must ensure it has enough money to buy ingredients, pay staff, and maintain equipment. If a business doesn't manage its finances properly, it could struggle to meet these costs. Another important role is investment in business growth. Expanding a business often requires funding for new stores, equipment, or technology. Tesco, for instance, invests in self-checkouts and digital marketing to improve efficiency and attract more customers. Without finance, businesses would struggle to grow and compete. Finance also helps in decision-making. Business owners and managers use financial data to decide on pricing, hiring staff, and expansion plans. For example, a retailer might analyze its financial statements to see whether it can afford to open a new store. If profits are low, the business may delay expansion or seek external funding. Another key aspect of finance is managing risk. Businesses face financial risks such as unexpected expenses, low sales, or economic downturns. A business with strong financial management will set aside emergency funds or take out insurance to reduce risks. For example, airlines like British Airways must plan their finances carefully to handle fuel price fluctuations. Finally, finance plays a role in measuring business performance. Companies use financial statements to track profitability, costs, and efficiency. If a company sees rising costs and shrinking profits, it may need to adjust its operations. Financial analysis helps businesses identify problems early and take corrective action. Without finance, businesses would struggle to survive, grow, or make informed decisions. This is why the finance function is one of the most important parts of any organization. Having explored the finance function and its importance, it's time to look at how businesses secure the money they need. Businesses use different sources of finance, depending on their needs, size, and financial position. We are moving on to the different sources of finance available to businesses and how they decide which one to use.
Businesses need money to operate, expand, and remain competitive. Choosing the right source of finance is crucial as it affects cash flow, debt levels, and long-term financial stability. Different businesses require different types of finance depending on their size, financial position, and objectives. There are two main categories of business finance: short-term and long-term finance. Short-term finance is used to cover day-to-day expenses and unexpected costs, while long-term finance helps businesses fund expansion and major investments. One common short-term source of finance is an overdraft. This allows businesses to withdraw more money than they have in their account, providing flexibility when cash flow is tight. However, overdrafts often come with high interest rates, making them expensive if not managed well. Trade credit is another short-term option where suppliers allow businesses to delay payments for stock or materials. This improves cash flow but relies on suppliers trusting the business to pay on time. A bank loan is a widely used long-term source of finance. Businesses borrow a fixed amount and repay it with interest over an agreed period. This is useful for expansion, purchasing equipment, or investing in new projects. However, interest rates and repayment terms must be carefully considered, as failing to meet repayments can put the business at risk. Another long-term option is retained profit, where businesses reinvest their earnings instead of paying them out to owners or shareholders. This is a cost-effective way to fund growth as it avoids interest payments or external borrowing. However, it depends on the business making enough profit, which may not always be possible. Venture capital is a form of investment where external investors provide funding in exchange for a share of the business. This is commonly used by startups and high-growth companies. While it provides access to large sums of money, it means giving up partial ownership and decision-making control. Businesses can also raise finance through crowdfunding, where multiple investors contribute small amounts via online platforms. This is useful for businesses with innovative ideas or strong community support, but it requires effective marketing to attract investors. Selecting the right source of finance depends on several factors, including the amount needed, repayment ability, and the level of control the business is willing to give up. Small businesses may rely more on overdrafts and trade credit, while larger companies may use bank loans, retained profits, or external investment. Having explored different sources of finance, the next focus is on how businesses track and measure financial success. Financial terms and calculations help businesses understand revenue, costs, and profitability. We are moving on to key financial terms and how businesses use calculations to assess performance. Understanding key financial terms is essential for businesses to track their performance and make informed decisions. Financial calculations help businesses determine profitability, efficiency, and financial stability, allowing them to plan effectively and remain competitive. One of the most important financial terms is revenue, also known as sales turnover. This is the total money a business earns from selling goods or services before any costs are deducted. For example, if a clothing retailer sells 1,000 jackets at £50 each, its revenue is £50,000. However, revenue does not indicate profit because businesses have costs to cover. Costs refer to the expenses a business incurs while operating. These can be divided into fixed costs and variable costs. Fixed costs remain the same regardless of sales, such as rent, insurance, and salaries. Variable costs change depending on output, such as raw materials, packaging, and delivery costs. Managing costs effectively is crucial for maintaining profitability. Profit is what remains after deducting costs from revenue. There are two main types: gross profit and net profit. Gross profit is calculated by subtracting cost of sales, the direct costs of producing goods, from revenue. However, businesses also have operating expenses like rent, wages, and advertising. Once these are deducted, the remaining figure is net profit. For example, if a bakery generates £100,000 in revenue, spends £40,000 on ingredients cost of sales, and incurs £30,000 in operating expenses, its gross profit is £60,000 and its net profit is £30,000. Net profit is an important indicator of a business's overall financial health. Another key term is break-even point, which is the level of sales a business must achieve to cover its costs. This is essential for businesses to understand when they will start making a profit. A business that consistently operates below its break-even point is at risk of financial failure. Interest rates also play a crucial role in business finance, especially for businesses that borrow money. If a company takes out a loan, it must repay the original amount plus interest. Higher interest rates increase borrowing costs, making it more expensive for businesses to finance expansion or manage cash flow. Businesses use financial calculations to make important decisions. By analyzing revenue, costs, and profit margins, they can determine pricing strategies, identify cost-saving opportunities, and assess overall performance. Having covered key financial terms and their importance, it's time to explore how businesses use break-even analysis to plan for profitability and minimize financial risks. We are moving on to break-even analysis and how businesses calculate and interpret break-even points. Businesses must understand their financial position to ensure they remain profitable. One way to do this is through break-even analysis, which helps businesses determine the level of sales needed to cover costs. Another important financial factor is interest rates, which affect borrowing costs and business decisions. Break-even analysis is used to calculate the point at which a business's total revenue equals total costs, meaning no profit or loss is made. This is known as the break-even point. Any sales beyond this point generate profit, while sales below this level result in a loss. To calculate the break-even point, businesses use the break-even formula, which is fixed costs divided by contribution per unit. Contribution per unit is the amount that each product sold contributes toward covering fixed costs after variable costs have been deducted. It is calculated by subtracting the variable cost per unit from the selling price per unit. For example, if a bakery sells cakes for £5 each and the variable cost per cake is £2, the contribution per cake is £5 minus £2, which equals £3 per cake. Once contribution is calculated, the break-even point is found by dividing total fixed costs by the contribution per unit. If the bakery has fixed costs of £10,000, the break-even point is £10,000 divided by £3 per cake. This gives a break-even point of 3,333 cakes. This means the bakery must sell at least this amount before making a profit. Understanding this helps businesses set sales targets and pricing strategies. Another key concept in break-even analysis is the margin of safety, which measures how much sales can drop before the business starts making a loss. If the bakery normally sells for 1,000 cakes per month, the margin of safety is calculated by subtracting the break-even point from actual sales. 4,000 cakes minus 3,333 cakes. This results in a margin of safety of 667 cakes. A high margin of safety reduces financial risk, while a low margin means even a small drop in sales could lead to losses. Break-even analysis is useful for businesses when launching new products, setting prices, or planning expansions. However, it has limitations. It assumes that all units are sold, costs remain constant, and there are no unexpected expenses, which may not always be realistic. Another crucial financial factor for businesses is interest rates. Businesses often borrow money through loans or overdrafts to fund operations or expansion. Interest is the cost of borrowing, and it is expressed as a percentage of the loan amount. If a business borrows £20,000 at an interest rate of 5% per year, the interest cost is calculated by multiplying £20,000 by 5%. This results in an interest payment of £1,000, meaning the total repayment after 1 year would be £21,000. The higher the interest rate, the more expensive borrowing becomes. Interest rates affect business decisions in several ways. When rates are low, businesses are more likely to take out loans to expand. When rates are high, borrowing becomes expensive, which may discourage investment. Businesses also need to consider interest rates when offering credit to customers, as higher rates may reduce consumer spending. A business must carefully assess whether borrowing is the right decision. If the expected return on investment is higher than the interest cost, borrowing may be beneficial. However, if loan repayments become unaffordable, the business may struggle with cash flow. Having covered break-even analysis and interest rates, we are moving on to financial statements and how businesses use them to measure performance and make informed decisions. Financial statements provide businesses with a clear picture of their performance, financial health, and decision-making needs. These reports help businesses assess profitability, manage costs, and plan for future growth. The two main financial statements are the income statement and the statement of financial position, also known as the balance sheet. The income statement, also called the profit and loss account, shows a business's revenue, costs, and profit or loss over a specific period. Revenue, also known as sales turnover, represents the total amount of money received from selling goods or services. The cost of sales refers to the direct costs of producing those goods or services. Gross profit is calculated by subtracting the cost of sales from revenue. However, businesses also incur operating expenses such as rent, wages, and marketing costs, which are deducted to determine net profit. For example, if a clothing business generates £100,000 in revenue, has £40,000 in cost of sales, and £15,000 in expenses, its gross profit is calculated by subtracting the £40,000 from £100,000, which leaves £60,000. To find the net profit, the £15,000 of expenses are deducted from gross profit, leaving a net profit of £45,000. Net profit is important because it shows whether a business is truly profitable after covering all costs. The second key financial statement is the Statement of Financial Position, also known as the balance sheet, which provides a snapshot of a business's financial position at a specific point in time. The main components of the balance sheet are assets, liabilities, and capital. Assets represent everything the business owns and are divided into fixed assets such as buildings and equipment, and current assets such as cash and inventory. Liabilities refer to everything the business owes, including long-term liabilities like bank loans and current liabilities such as unpaid supplier bills. Capital, also called owner's equity, represents the money invested into the business along with retained profits. The balance sheet follows the accounting equation, which states that assets must always be equal to liabilities plus capital. If a business has £200,000 in assets and £150,000 in liabilities, then the owner's capital is calculated by subtracting liabilities from assets. £200,000 minus £150,000 leaves £50,000 in capital. This equation ensures that everything the business owns is financed either by borrowing money or through investment. Both financial statements help businesses, investors, and lenders understand how well a company is performing. A strong net profit and high-value assets indicate stability and growth, while rising liabilities or shrinking profits may signal financial risk. Having covered financial statements and their key components, we are moving on to interpreting financial data and how businesses use financial statements to assess performance and make strategic decisions. Financial statements help businesses analyze their performance, identify strengths and weaknesses, and make informed decisions. Understanding how to interpret financial statements allows businesses to assess profitability, efficiency, and financial stability. By analyzing key figures, businesses can plan for growth, control costs, and avoid financial risks. The income statement, also called the profit and loss account, provides insight into how profitable a business is over a given period. One of the most important figures is revenue, which shows the total amount of money the business has earned. However, high revenue does not always mean a business is performing well. If costs are too high, profits may be low, even with strong sales. Businesses must compare revenue against the cost of sales, which includes direct costs such as raw materials or stock purchases. Subtracting the cost of sales from revenue gives gross profit. A higher gross profit indicates that a business is managing its production costs effectively, while a lower gross profit may suggest rising costs or pricing issues. The next step is to analyze net profit, which is found by deducting operating expenses from gross profit. Net profit represents the actual earnings after all costs have been paid, including rent, wages, and marketing. A strong net profit suggests that a business is managing its costs well, while a declining net profit may indicate that expenses are increasing too quickly. Investors and lenders often look at net profit to determine whether a business is financially stable and capable of repaying loans or reinvesting in growth. The Statement of Financial Position, or balance sheet, provides a snapshot of a business's financial health at a particular moment in time. One of the key figures to analyze is total assets, which include everything the business owns. Fixed assets, such as buildings and machinery, are used in long-term operations, while current assets, such as cash and stock, can be converted into money quickly. Businesses must have enough current assets to cover their short-term expenses. If current assets are too low, the business may struggle to pay suppliers, wages, or other short-term debts. Liabilities must also be carefully analyzed. Current liabilities are short-term debts that need to be repaid within a year, such as supplier payments and short-term loans. Long-term liabilities include larger debts, such as bank loans that are repaid over several years. A business must balance its liabilities with its assets to avoid financial strain. If liabilities exceed assets, the business may be at risk of insolvency. Another key figure is capital, which represents the money invested into the business and any retained profit. However, in companies, this is often referred to as equity instead of capital. Equity includes money invested by shareholders and retained earnings that the business reinvests for future growth. For sole traders and partnerships, capital refers to the money invested by the owners, whereas in limited companies, equity includes shareholder contributions and profits kept in the business. A strong capital or equity base suggests financial stability, while low capital or declining equity may indicate that a business is heavily reliant on borrowing. Comparing capital or equity to liabilities helps assess whether a business is operating sustainably or taking on too much financial risk. Interpreting financial statements involves comparing figures over time and analyzing trends. If revenue is increasing but net profit is falling, the business may have rising costs that need to be controlled. If liabilities are increasing faster than assets, the business may be relying too much on borrowing. Financial ratios, which compare key figures, are also useful in analyzing financial health. These ratios help businesses, investors, and lenders assess profitability, liquidity, and efficiency. Having covered how to interpret financial statements, we are moving on to the average rate of return and how businesses use this calculation to assess the profitability of investments. Businesses often need to decide whether an investment is worthwhile. Before committing to large purchases such as new machinery, expanding operations, or launching new products, they must analyze whether the expected returns justify the cost. One way to measure this is through the average rate of return, or ARR, which helps businesses compare the profitability of different investments and decide where to allocate funds. ARR calculates the average annual profit of an investment as a percentage of the initial cost, making it easy to compare with other potential investments. A higher ARR indicates that the investment is likely to generate good returns, while a lower ARR suggests it may not be profitable enough. To calculate ARR, businesses follow three key steps. First, they determine the total profit from the investment by subtracting the initial cost from the total expected revenue over the investment period. Second, they find the average annual profit by dividing total profit by the number of years the investment will last. Finally, they calculate ARR by dividing the average annual profit by the initial cost and multiplying by 100 to express it as a percentage. For example, if a business invests £50,000 in new equipment and expects to generate £75,000 in total revenue over 5 years, the first step is to calculate total profit. £75,000 minus £50,000 gives a total profit of £25,000. Next, the average annual profit is calculated by dividing total profit by the number of years. £25,000 divided by 5 years equals £5,000 per year. Finally, the ARR is found by dividing the average annual profit by the initial investment and multiplying by 100. £5,000 divided by £50,000 multiplied by 100 gives an ARR of 10%. This means the investment is expected to generate a return of 10% per year, which can be compared with other investment opportunities. If another potential investment has an ARR of 15%, it may be more attractive because it offers a higher return. ARR is useful because it allows businesses to make informed decisions when choosing between investment options. However, it also has limitations. One major drawback is that ARR does not consider the time value of money, meaning it treats profits received in later years as equally valuable as profits received earlier. In reality, money received sooner is often more valuable because it can be reinvested or used to cover costs. ARR also does not account for cash flow fluctuations, which could impact a business's ability to finance an investment. Despite its limitations, ARR remains a widely used financial tool because of its simplicity and ease of comparison. Businesses must weigh its results alongside other financial calculations such as payback period and net present value to make the most informed decisions. Having covered how businesses calculate and use the average rate of return, we are moving on to profitability ratios, specifically gross profit margin and net profit margin, and how businesses use these to measure financial performance and efficiency.
Businesses must regularly assess their financial performance to ensure profitability and long-term sustainability. One way to do this is by using profitability ratios, which help businesses measure how efficiently they generate profit from their revenue. Two key profitability ratios are the gross profit margin and the net profit margin, both of which provide insight into how well a business is managing its costs and turning revenue into profit. Gross profit margin measures the percentage of revenue that remains after deducting the cost of sales. This ratio shows how efficiently a business is producing or sourcing its products. It is calculated using the formula gross profit divided by revenue multiplied by 100. For example, if a business generates £100,000 in revenue and has a gross profit of £40,000, the gross profit margin is calculated by dividing £40,000 by £100,000 and then multiplying by 100, resulting in a gross profit margin of 40%. This means that for every pound earned in revenue, 40 pence remains as gross profit after covering direct costs such as raw materials and manufacturing expenses. A high gross profit margin indicates that a business is effectively managing its production or purchasing costs. A low gross profit margin may suggest rising costs or pricing issues, which could put pressure on overall profitability. Businesses can improve their gross profit margin by reducing production costs, negotiating better supplier deals, or increasing prices, provided that demand remains strong. While gross profit margin focuses on direct costs, net profit margin takes into account all expenses, including overheads such as rent, wages, and marketing costs. It provides a clearer picture of overall profitability. The net profit margin is calculated using the formula
net profit divided by revenue multiplied by 100. For example, if a business has a net profit of £10,000 from revenue of £100,000, the net profit margin is calculated by dividing £10,000 by £100,000 and then multiplying by 100, resulting in a net profit margin of 10%. This means that for every pound earned in revenue, 10 pence remains as net profit after covering all expenses. A high net profit margin indicates strong financial health and cost control, while a low margin suggests that expenses are eating into profits. If net profit margins decline over time, businesses may need to review their spending on salaries, advertising, or administrative costs to remain competitive. Both gross and net profit margins help businesses compare performance over time and against competitors. If a company's gross profit margin remains stable but its net profit margin declines, it may indicate that overhead costs are rising. Comparing these ratios to industry benchmarks allows businesses to identify whether they are performing efficiently or need to improve cost management strategies. Having covered how businesses use gross profit margin and net profit margin to measure profitability, we are moving on to liquidity ratios, specifically the current ratio, and how businesses assess their ability to meet short-term financial obligations. Businesses need to ensure they have enough money to cover their short-term financial obligations. One way to measure this is by using liquidity ratios, which assess a company's ability to pay its debts as they fall due. A key liquidity ratio is the current ratio, which compares a business's current assets to its current liabilities to determine whether it has enough resources to meet short-term expenses. The current ratio is calculated using the formula current assets divided by current liabilities. Current assets include everything a business owns that can be converted into cash within a year, such as cash, stock, and money owed by customers, known as trade receivables. Current liabilities include debts that must be repaid within a year, such as supplier payments, bank overdrafts, and short-term loans. For example, if a business has £50,000 in current assets and £25,000 in current liabilities, the current ratio is calculated by dividing £50,000 by £25,000, giving a current ratio of 2:1. This means the business has £2 of current assets for every £1 of current liabilities, indicating a strong short-term financial position. A current ratio of greater than 1 suggests that a business has more assets than liabilities, meaning it should be able to meet its short-term financial commitments. A ratio of less than 1 means the business may struggle to pay its debts and could face cash flow problems. A very high current ratio, such as for 2:1, may indicate that the business is holding too much cash or stock instead of reinvesting in growth. The ideal current ratio depends on the type of business. Retail businesses, such as Tesco or Primark, often have lower current ratios because they sell stock quickly and receive cash payments from customers, meaning they do not need to hold large amounts of assets. In contrast, manufacturing businesses such as Rolls-Royce or Gcse may have higher current ratios because they need to store raw materials and finished products before selling them. Businesses use the current ratio to assess financial health and make decisions about spending and borrowing. If the ratio is too low, they may need to improve cash flow by speeding up customer payments, reducing unnecessary stock, or negotiating better payment terms with suppliers. If the ratio is too high, they may consider reinvesting excess cash into expansion, marketing, or research and development. Having covered how businesses use the current ratio to measure liquidity, we are moving on to cash flow. Why it is critical for business survival, and how businesses manage their cash effectively. Cash flow is one of the most critical factors in business survival. A business can be profitable on paper but still fail if it does not have enough cash to pay its expenses when they are due. Cash flow refers to the movement of money in and out of a business, and managing it effectively ensures that a business can pay its suppliers, employees, and other expenses while continuing to operate smoothly. Cash flows into a business through revenue from sales, loans, or investments, while cash flows out through expenses such as rent, wages, stock purchases, and loan repayments. The difference between cash inflows and cash outflows determines whether a business has a positive cash flow or a negative cash flow. Positive cash flow means more money is coming in than going out, which allows a business to cover its expenses and reinvest in growth. Negative cash flow occurs when more money is going out than coming in, which can create financial difficulties and even lead to insolvency if not addressed. Even profitable businesses can experience cash flow problems if payments from customers are delayed or if they tie up too much money in unsold stock. For example, a furniture retailer may generate high sales revenue but struggle with cash flow if customers are given long credit terms and the business does not receive payment for months. Similarly, a manufacturer may face cash flow shortages if too much money is tied up in raw materials and production before receiving revenue from sales. Cash flow is particularly important for small businesses and startups as they often have limited financial reserves. Unlike large corporations, which can borrow easily or use retained profit to manage shortfalls, small businesses rely on steady cash flow to keep operating. If cash inflows slow down, they may struggle to pay suppliers, staff, or rent, which can quickly lead to financial distress. Businesses use cash flow forecasting to predict how much money will be coming in and going out over a specific period. This allows them to prepare for potential cash shortages and take action before problems arise. A cash flow forecast helps businesses decide when to pay suppliers, when to invest in new stock, and when to chase overdue payments from customers. To improve cash flow, businesses may take several actions. They can reduce the amount of stock held, ensuring that money is not tied up in unsold goods. They may also negotiate better payment terms with suppliers, allowing them to delay outgoing payments while still receiving stock on time. Chasing late payments from customers and offering discounts for early payment can also help bring in cash more quickly. Businesses may also arrange short-term financing, such as an overdraft or invoice factoring, to bridge cash flow gaps. Managing cash flow effectively ensures that businesses can meet their short-term obligations while planning for long-term growth. Having covered why cash flow is important and how businesses manage it, we are moving on to cash flow forecasting and how businesses predict and interpret their future cash movements. Businesses must plan their finances carefully to avoid cash shortages that could disrupt operations. One way to do this is through cash flow forecasting, which helps businesses predict how much money will be coming in and going out over a specific period. By forecasting cash flow, businesses can prepare for potential shortfalls, make informed decisions, and ensure they have enough money to cover expenses. A cash flow forecast is a financial document that estimates a business's expected cash inflows and outflows over a set time frame, usually a month or a year. Cash inflows include money received from sales, loans, and investments, while cash outflows include payments for rent, wages, stock, and loan repayments. The difference between inflows and outflows determines the closing balance, showing how much cash the business expects to have at the end of each period. To prepare a cash flow forecast, businesses list expected cash inflows, followed by planned outflows. Net cash flow is calculated by subtracting total outflows from total inflows. This figure is then added to the opening balance to determine the closing balance. A positive closing balance means the business is expected to have surplus cash, while a negative closing balance suggests a potential shortfall. For example, if a business starts with £5,000 in its bank account, expects £10,000 from sales, and has outflows of £8,000, net cash flow is calculated by subtracting outflows from inflows. £10,000 minus £8,000 leaves £2,000. The closing balance is found by adding this to the opening balance. £5,000 plus £2,000 results in a closing balance of £7,000. Interpreting a cash flow forecast helps businesses identify potential problems. If the forecast shows a negative closing balance in an upcoming month, the business can take action to avoid running out of cash. It may delay spending, negotiate better payment terms, or arrange short-term finance such as an overdraft. If the forecast predicts strong positive cash flow, the business may reinvest in stock, marketing, or expansion. A cash flow forecast is useful but not always completely accurate. External factors such as unexpected costs, delayed customer payments, or changes in demand can impact actual cash flow. Businesses regularly update forecasts to reflect real-time data and adjust when needed. Having covered cash flow forecasting and how businesses interpret these forecasts to make financial decisions, we are moving on to final financial considerations and key takeaways from the finance unit, ensuring businesses and students understand the most critical financial concepts for success. Finance plays a crucial role in every business, influencing everything from daily operations to long-term growth. Throughout this series, we have explored key financial concepts that businesses use to make informed decisions. Understanding these principles helps businesses stay financially stable, manage risks, and plan for the future. One of the most important aspects of finance is knowing how to fund business operations. Businesses choose between different sources of finance, including bank loans, retained profit, venture capital, and crowdfunding, depending on their needs and financial position. Selecting the right source is essential for maintaining financial health and avoiding excessive debt. Financial calculations also help businesses assess performance and plan strategically. Break-even analysis determines the level of sales needed to cover costs, while the average rate of return helps businesses decide whether an investment is worthwhile. These calculations allow businesses to set realistic financial targets and measure profitability. Understanding financial statements is equally important. The income statement, also known as the profit and loss account, reveals whether a business is making a profit, while the statement of financial position or balance sheet shows assets, liabilities, and overall financial stability. In companies, capital may also be referred to as equity, representing shareholder investments and retained earnings. Analyzing these statements helps businesses and investors evaluate financial health. To measure efficiency and profitability, businesses use financial ratios such as gross profit margin, net profit margin, and the current ratio. Profitability ratios indicate how well a business is converting revenue into profit, while liquidity ratios assess whether a business can meet its short-term financial commitments. Monitoring these figures helps businesses adjust strategies and improve performance.
Cash flow management is another essential part of financial planning. Even a profitable business can fail if it does not have enough cash to pay its expenses when they are due. Cash flow forecasting helps businesses predict future cash movements, ensuring they have enough funds available for operations. Businesses improve cash flow by managing credit terms, reducing stock levels, and negotiating better payment terms with suppliers. Interpreting financial data allows businesses to make informed decisions about pricing, cost control, and investment. Comparing financial performance over time and against competitors helps businesses identify areas for improvement. Regularly reviewing financial statements and forecasts ensures businesses stay on track and avoid financial difficulties. While this series has provided a strong theoretical understanding of finance, true confidence in finance comes from practice. Financial calculations are always examined, so it is essential to master them through past exam papers, textbook exercises, and timed practice questions. Being able to recall formulas quickly and apply them accurately is crucial for exam success. Exams will test more than just knowledge of definitions. They will assess how well students can calculate, interpret, and explain financial data in business contexts. Whether it is break-even analysis, profit margins, or cash flow forecasting, students must be prepared to handle both numerical and written questions with confidence. The best way to build that confidence is through regular practice, reviewing worked examples, and identifying common mistakes before the exam. Finance is not just about numbers, it is about making strategic decisions that drive business success. Whether assessing risk, managing cash flow, or planning for future growth, strong financial management is essential. Businesses that understand and apply these financial principles are better positioned to remain competitive and achieve long-term sustainability. Thank you for listening to Mr. G. Please like, subscribe, and comment.